with chaos at the New York Stock Exchange.
Get back in there at once and sell! Sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. My birthday, June 7th, 2024. Glad you're tuning in. Big time shout outs to so many. I saw so many people listen in every week this week. So many people that I can't name them all, but some of them had a big old party right there in my lobby one afternoon. So just thank you all for tuning in and getting value out of the program. We really appreciate that. So let's go ahead and jump into the numbers. It was a sloppy week for the market. Dow Jones was up 0.3%. S&P 500 also up 1.3% and hit a new record high. So I am glad we put money to work when we did because the markets did trend higher. NASDAQ Composite up 2.37%. The Russell Small Caps down a bit. They were down 2.1%. A lot of that's due to interest rates and things like that. We'll talk about that in a moment. Taking a look at the volatility index. Actually, interestingly enough, it was a bit of a sloppy week, but that was down 5.4%, down around 12.2 on the VIX. That's a very complacent looking number. Hey, we'll take it. The long-term bonds, the TLT, that went up a bit, up 1.1%. So bonds getting a little bit of love there. And then looking at the sectors, again, a real mixed bag this week. Retail sales were down 1.9%. Utilities, which have been on fire, down 3.8% this week. Energy down 3.4%. But then you look at other areas, technology was up 2.5%. Communication services up 1.4%. Semiconductors up 4.8%. So a real mixed bag. And I can't really say that the market was really telling us much of anything this week. I mean, healthcare was up 1.9%. Utilities were down 3.8%. Guess what? Both of those sectors are very defensive, and there's a completely different message between those two. And then you see tech up 2.5%. So I don't think the market really said a whole lot. Gold was down 1.7%, silver down 3.9%, and all of that happened today. And I can tell you why here in just a moment. And also, just for those that have inquiring minds, Shopify was up 4.9% this week. ServiceNow was up 9.3% this week. And Uber was up 7.5% this week. And if you want to know why that's important, those three, the reason why I called those out, well, listen to last week's podcast or sign on and take a look at your account holdings. Real happy to see those stocks move in so quickly. As far as changes this week, I got rid of copper. I should talk about that. We've got Freeport-McMoRan we had in the model. It's up 37% over the past year. And look, the charts on copper are suddenly looking kind of like sloppy and extended. One really awesome commodities technician is saying that it looks like copper has topped out, and looking at Freeport-McMoRan individually, it's reflecting some extended numbers there on the DeMark charts, 9s and 13s. You know, one technician that I talked to feels that copper has broken out to a new uptrend. And we discussed that a bit, but she also said that it also looks like, you know, the downside from copper, this is from yesterday to today, downside looks like around $44, which is like 12% lower from where we were at. So I went ahead and sold it yesterday and got out of that one. I still think copper long-term could be interesting because of all this increase in electrification of everything. But for the time being, you know, it looks a little maxed out. And also, I'll tell you something else about copper. Traditionally and historically, copper tends to roll over before the market. Before we have like a recessionary type of bear market, copper tends to roll over beforehand, sometimes like on average, I'd say around 9 months ahead of time. So that also to me is a little like, I'm kind of watching that one pretty close. Because, you know, my school of thought is that we're not out of the woods yet on recession. I still think it's in the cards. I don't think it's in the cards for this year. I think it's probably more likely in 25 into 26. I also think the stock market, as measured by the S&P 500, has a solid 15% gain probably ahead of it before we have to worry too much. That said, we did take that off the table this week. So did one piece of selling. We sold Freeport-McMoRan. So what moved markets this week? Well, there's not a whole lot of news, and things just seem to be hanging in and holding together, and the market's just drifting higher. That said, today was a bit of a thunderstorm, if you will. The jobs number came out this morning, and what's interesting was the market was looking for 190,000 jobs, and it was reported 272,000. Almost 100,000 more jobs created in the month of May than anticipated. But the real kicker was wages increased even further, hotter than anticipated, up 0.4 on wages. And why is that a bad thing? Well, it's good if you have a job and got a pay raise, but it's bad when it relates to inflation. And we saw a lot of squirrely things take place in the market today. Gold collapsed today, down 3.5% today. Silver down 6.5% today. And the reason being that there is fear that not only will the Fed not be cutting rates anytime soon, there is real conversations taking place that the Fed may even have to hike again. And the market is on the wrong side of that. It's not prepared for that. That's not priced in. Now, I don't necessarily think it's a bad thing because it means the economy is pretty strong if they're hiking rates yet again. But I will say this, we're seeing some severe cracks in certain areas of the economy. Manufacturing PMIs are awful. Now, service PMI numbers came out, and that gave the market a lift this week. Those numbers were much better. But I'm seeing things that are, again, I think I've used the word sloppy already 2 times in this podcast. Let's use it 3 times. The economy is starting to look sloppy. And earlier this week, I thought to myself, and I actually mentioned it to clients, I've been in the camp that the Fed should just hold tight, right? Not do anything right now. The economy's humming along at these levels of interest rates. But some of the data that I've seen in the last couple of weeks, I'm in the camp now that I think the Fed needs to cut. Nothing crazy, nothing major. I think they need to give the market a little something, give the economy a little something. What tends to happen historically, and it happens time and time and time again, the Fed waits too long to cut rates and something breaks and we have a recession or something worse, like 0809. I would call that worse than a traditional recession. No, I don't see anything in the cards that would look like 0809. There's just nothing brewing right now that looks like that to me. But I will say that the economy is looking a little rough, and I think the Fed should probably look to cut just to give the economy a little something to grasp hold of. The problem is, and it was revealed today, and we saw it unfold in the market today, the problem is inflationary pressures remain, especially in the form of wage increases. And the big fear that the Fed has, I mean, what's worse than a recession? Runaway inflation. Runaway inflation is worse, folks. Better off that we have a recession, the market drop, and we work our way through it and do some selling, do some buying, maybe have a little bit of pain in 25 or 26, but come out and making a lot of money. Better to do that than to have double-digit inflation like we saw in the early 80s. The Fed is terrified that if they move too soon, inflation is going to come back with a vengeance like it did back then, and they're going to have almost an impossible time of trying to beat it back. I understand. And you know what? And I'm glad I don't have that job. I'm glad I don't have to make these decisions because they're tough ones to make. You're looking at the data, you're monitoring everything. I would say that it looks to me like inflation was mainly driven by COVID money chasing after too few goods and services and really drove things up. And things have really righted themselves and cooled off on that front. I think the Fed should probably look more at the economic data and maybe get ahead of that because, if you're looking at the labor market, that's the last thing to break. It's always the last thing to crack. It's the labor market. So you can't go off of that. You've got to go off of other things. I think they're better off at least just taking a little tiny bit off the table with the rate cut and seeing how things react. And inflation starts becoming an issue, and then you go put it back in again, right? I'm not saying we should go from where we're at now and cut 300 basis points, drop it by 3% or something crazy. But I do think a little bit of cutting could be in store. We'll see. Right now, I like where we stand. We've got plenty of money in bonds. We've fully allocated on the equity front. Did raise up a little bit more cash this week with the selling of Freeport-McMoRan, but I think the market can press higher. the resiliency this market has shown has just been tremendous. Even today being a rough day, it looked so much worse and the market rebounded pretty significantly. So it just seems like it wants to go higher. Historically, presidential election years, the market elevates during the summer, drops right prior to the election, and then rebounds pretty solidly post-election. I would just kind of expect the same thing unless something comes up to make us think otherwise. So I think I talked quite a bit today, and I'm going to go ahead and wrap up. But look, between now and next we meet, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's that big, massive home improvement project that you've been putting off a little bit, or buy that second house and Airbnb-ing it, or buy that boat or RV, or pay for college, whatever the case may be. Don't just think about it. Think big. Think BIG, and I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.